Hi everyone, so today we're going to look at another concept of finance, and since I'm specialized in ETFs or exchange traded funds, that's what I'm gonna talk about today. So to make it short, the exchange traded funds or ETFs are first on an exchange. That means they're quoted on a market, for example, New York Stock Exchange or Nasdaq. Then they're traded by definition, exchange traded funds. Traded means they're continuously traded during the opening hours of that market, as opposed to other funds, which are most of the time only quoted once per day at one price, and they're less liquid. So ETFs are more liquid and continuously traded, and then they're funds. So fund in finance is just a collective investment, which means multiple shareholders pool their money and make it into holdings. So that's an ETF. What's the purpose of an ETF? The purpose is, compared to other funds, they're more easily accessible. Habitually, like previously, funds were something you had to subscribe to, so either physically or through a form or something, and you had a pretty big ticket of entry, which is very, very low for ETFs. It can be as low as, I don't know, $10 or even less than that. So they are easily traded, more traded, and the more something is traded, the more liquid it is. So the less spread and fees you will have, and the easier it will be to buy it and sell it without incurring too much problems of price. And so liquidity, very, very important. And then they're aimed at replicating something. So they're replicating most of the time an index or something like that. They can replicate gold, an index of multiple stocks. For example, the S&P 500, which is comprised of the top 500 biggest companies in the US by market capitalization. So if you are an individual, you can buy all these 500 companies. It will be very long, very tedious. You will have to rebalance every day. If, I don't know, Apple takes more of the S&P 500 overnight, you have to rebalance everything. So as an individual investor, it's very hard to buy all these stocks, and also very costly in terms of fees, and every time you do a transaction you have to incur fees. So if you buy an ETF, that's very easy for you to be exposed to all these companies without having to incur the fees for 500 companies. The price of an ETF is very interesting because, as opposed to other funds, the price is not only derived from the net asset value of the underlying, it's also derived by offer and demand. For example, if you want to buy something, you will increase the demand for that thing, so the price will rise up. Also, if a lot of people want to sell it at one point and there's not enough demand, then the price will fall because people want to get rid of it. So the offer and demand couple gives a huge price factor. And then there can be multiple underlyings for an ETF. There can be, for example, equities, so an index like Nasdaq. It can also target specific sectors, for example, automotive. Then it will have multiple stocks for the automotive industry. It can also target specific geographies, so for example, Europe or Asia. And you can also have Asia excluding China or excluding Japan, something like that. You can have ETFs for other things than equities. You can have it for fixed income, so for example, US bonds. And then you can have commodities ETFs, so for example, gold, copper, oil, everything. And also ETFs for cryptocurrencies. So it's easier than just buying these cryptocurrencies, incurring fees, having to keep them on a wallet. You can buy a Bitcoin ETF. And then, so all this is very simplified, but I just want to give an overview. There are multiple ways to structure an ETF. There's something called replication. So for example, the ETF is trying to replicate the S&P 500. They can do that by multiple ways. They can replicate fully, so they can buy the whole index, so the whole 500 companies in that example. Or they can do an optimized replication where they find that, I don't know, the top 50 companies represent 99% of the performance of the S&P, and maybe they will try to optimize the replication so that they incur less fees, and so that you as a customer, you pay less fees. And then there is a synthetic replication with swaps or derivatives. That means they have a contract with an investment bank, and they agree in the future to be delivered like the performance of the S&P 500. So they don't have to actually own the stock, or they can have just a part of it, or they can have collateral. But I'll dig deeper on that if you want. So yeah, that's it for ETFs.